Hello there, and welcome to my discussion on perpetual versus periodic inventory systems. Please read the pages in your textbook dedicated to this topic. Then print out the student handout that was made available to you on inventory and turn to page 2. I would like you to complete all of the journal entries in the first column for the perpetual inventory system, and we'll look at it first, and then complete the journal entries on page 2 in the right-hand column for periodic inventory system, and return to this podcast and we'll discuss those, and then we'll compare and contrast the two and wrap up our discussion. So, given that, let's get started. Well there, welcome. Let's begin our discussion on the perpetual inventory system. You, in your first journal entry, were to record the purchase of 100 units at $20 each. In the perpetual system, we keep the inventory account perpetually up to date. Since you've just bought inventory, we'll debit inventory to reflect that. In our second transaction, you're to pay a $200 freight bill for the purchase of this inventory. Notice that that is also debited to the inventory account. All costs, including in getting the inventory ready for its intended use, are capitalized into the inventory account. In our next transaction, we're to record a return of 20 units on account. We debit accounts payable to show that we owe less, and then we credit inventory. Again, since the actual physical account has changed, the journal entry changes with it. Now it comes time to record the payment for the inventory that we purchased and kept. Let's take a minute and see where we are in a T account involving that accounts payable. You'll recall we purchased $2,000 worth of inventory, and then we returned $400 in our accounts payable. 2,000 minus 400 leaves $1,600 in the account. So we need to credit inventory for $1,600. Recall also that there's a 2% discount if you pay within the discount period. 2% of the $1,600 is $32, and we get to take that discount. Notice that when we take a discount, we credit inventory for the amount of the discount under the theory that we have now paid less for that inventory. Finally, you're asked to record a sale of 40 units on cash. So we debit cash, credit the sale, and then cost of goods sold and inventory is triggered by this entry. Since the inventory is leaving, we need to credit the inventory account. How did we come up with that? Well, if you look at a T account for inventory, we can see the answer to that. We had $2,000 where we purchased inventory. We paid $200 freight. There was a $400 return, and we also had a $32 discount. If you total all of these, you'll see that we have $1,768 in our inventory account. Remember, this was for 80 units. So if you take $1,768 and divide it by 80, you'll see that that's $22.10 a unit. And we sold 40 of those. So 40 times 22.10 gives us our $884, and we immediately take that out of inventory because it's been sold. So our inventory account is now having half left in it. We've sold half, and we have half left. 40 units sold, 40 units left. Notice that our inventory account was kept perpetually up to date. It showed the purchase, it showed the freight, it showed the return, it showed the discount, and it showed the sale immediately. So, how did you do on recording perpetual inventory? Let's drop down a little bit and see what this might look like on an income statement. Notice that we have income of $1,200 from our sale. We have a cost of goods sold of $884, and using this method, our gross profit to date is $316. Well, that completes our look at perpetual inventory. Let's try periodic now. Put this on pause, go to your student handout, and complete column 2, the periodic method of accounting for inventory transactions. When you're done, come back and we'll review them. Welcome back, and let's review our discussion of periodic inventory transactions. So we're going to still record a purchase of 100 units, but under the periodic inventory method, transactions get put in accounts that are appropriately named. Purchases gets debited to a purchases account. Purchases is essentially an expense, and so we expense the inventory as soon as we buy it. Now, that assumes right from the beginning that we're going to sell all of our inventory, and you know that that can't be correct. But making that entry as an expense will get you a lot closer to what net income is going to be than not having any cost of goods sold expense as you go throughout the period. At the end of the period, we'll clean that up. Let's move on to our freight bill. When we pay freight to have inventory delivered to us, it gets recorded into a transportation in account, again an expense account appropriately named. When we return 20 units at $20 each, notice we credit accounts payable, and then we debit accounts payable, and we credit purchase returns and allowances. That is a contra expense account appropriately named. And then move on to our payment. The payment amounts haven't changed, and we've already reviewed that. You know how we get the $1,600 in accounts payable. But notice what happens to the inventory discount. It doesn't get posted to an inventory account. It gets posted into an account called purchases discount. Then when you sell 40 units at $30 each, you record the sale, and notice there is no cost of goods sold entry that accompanies this. That's because you've expensed all the inventory along the way. Well, when you get to the end of the accounting period, it's time to make an adjusting entry. We need to fix our cost of goods sold account. We need to include all of the different kinds of components that were involved in our journalizing, and we need to capture the change in inventory. Use all of that to net to a real cost of goods sold number. And this is done at the end of the period like all adjusting entries. I'm going to start, and you know, it's a little mock closing. It's an adjusting entry that closes everything to do with purchasing and journalizing inventory transactions and setting up the cost of goods sold account. So let me check these off in the order that they occurred. Remember that we had a purchase of $2,000. We debited that, so we credit it now to zero it. Then we had a freight bill we paid for $200, so we're going to credit that now to zero it. Then we had a purchase return of $400 that was credited, and we're going to debit it to zero it. And then we had a purchase discount that was also credited, and we're going to debit that to zero it. Then we're going to set up our ending inventory. Normally on a periodic system, you'd have to go out and count how much inventory is left. And you would find we have 40 units, and we would set that up. So we would debit inventory for how many units we have on hand, and we'd credit beginning inventory. What we're doing then is using all of those, and we take the net of that number. So if you add up all of the credits and subtract the debits, you'll find that 884 is the amount that makes that balance. And we've used all of those numbers to back into the account cost of goods sold. I'd like to talk a little bit about that beginning and ending inventory. We had in inventory, in our example, nothing to start with. And then we went out and counted, and we had 884 left at the end. In the periodic system, you would reverse your beginning number, which was nothing, and you would set up your ending number, which was 884. You capture the change from beginning to ending inventory and adjust cost of goods sold for that. It could go up if you've sold an amount that is different than you purchased. It could go down It just depends on what happens. In our case, inventory went up, so we're actually recording a debit here that makes cost of goods sold smaller because we've dedicated some of that money to setting up ending inventory. So this final adjusting entry then is what brings the periodic system into balance at the end of the period. Let's include now a look at our income statement. This would be what a typical income statement for a periodic accounting system could look like. Now you could just show cost of goods sold as one number, or you could give all the details. I've chosen to give the details. Here's our cell, and then we go into the calculation of cost of goods sold. Beginning inventory is 0 plus our purchases less discounts and returns equals net purchases. Add to that your transportation in, and that is your total goods available for sale during the period. Subtract from that the amount of your ending inventory account, and you'll have your cost of goods sold. Since I have exactly as much left as I sold, the numbers happen to be equal in this example. Sales minus cost of goods sold equals gross profit. And as you'll recall, that was the same number we had for gross profit under the perpetual system. How did we cost our ending inventory? Well, we have $1,768 total costs involved in our inventory. And when we go out, we count. We know we had a total of 80 units. So if you take the 1768 and divide it by 80, it comes up to a cost per unit of $22.10. And $22.10 times 40 is how much we have left, and that's where we get the $884 that we show as ending inventory. So that shows you what you do with a periodic inventory system. Let's go back now and review in total what we've done. A perpetual inventory system keeps the inventory account perpetually up to date. When inventory arrives, the account's increased. When incidental costs occur, the account's increased. When inventory is returned, the account is decreased. And if a discount's taken, the account's also decreased. So all costs affecting inventory run through inventory. Finally, when inventory is sold, the account is immediately credited. So our inventory account picks up the purchase, it picks up the freight, it picks up the return, it picks up the discount, and it picks up the sale immediately throughout the period. So the inventory account is kept perpetually up to date, and at the end of the period, the general ledger account tracks all the activity. Let's compare that now with the periodic system. When you have a purchase, it's debited to an account that's appropriately named, purchases and expense account. Transportation goes in an account that's appropriately named. Purchase returns and allowances decreases that. It's a contra account to purchases, so it's a contra expense, and the same with purchase discounts. When you have a sale of inventory, there is no cost of goods sold entry because you don't keep track of the individual costs of sales. You've been expensing everything along the way. At the end of the period, you need to make an adjusting entry to capture the change in the inventory account because you might have sold more than you had, or you might have sold less. We didn't have a beginning inventory, so we couldn't have sold more than we have, but we did sell less. So let's review this entry. This entry is a mock closing, I'll call it, of all inventory accounts dropping their balance into cost of goods sold. I'll do it in the order that accounts happen. First we had a purchase, so we removed that. Then we had transportation in, we zero that. Then we had a purchase return, so we zero that, and a purchase discount and zero that. We had no beginning inventory, but I put the number here so you can see what it would look like. But we did have ending inventory that was $884 worth. We went out and counted, and we had 40 units, $22.10. would give 884. So we set that up. And then we check what all of those numbers net to, and we're out of balance by the amount of cost of goods sold. So we'll debit cost of goods sold for that amount, and in that way record it at the end of the period. So let's see what happened to our inventory account. Our inventory account increased by $884. It started at 0. Account shows 884 less, so we need to reflect that in our inventory account. Under both the perpetual and periodic method of accounting for inventory, we have $884 in our inventory account. Of course, that amount could change depending on what cost value method you use, but in our example, it held true. When we look at cost flows next, you'll see what I mean. Now let's take a quick look at the income statement. Both income statements show we have sales of $1,200. Both income statements show we have cost of goods sold of $884, and both income statements show that our gross profit is $316. So there wasn't a difference in net income by the way that we did accounting. Periodic or perpetual won't cause a change in net income. Cost flow can, FIFO, LIFO, and weighted average, but merely recording under periodic or perpetual shouldn't affect the values in your inventory accounts. Well, there you go. Thanks for joining me. Hope you enjoyed that. Let's keep going.